investors shouldn't take the role that banks had before Lehman crisis. So this is something where I say, be aware of the risk, because if you look at your counterpart in EU, it's fine if we are viewed that we always will survive, but you never know. And then you have a crisis not only in the banking industry, but also in the insurance industry, which nobody wants to have. Yeah, this brings me to my last slide. Current issues, Gottfried, I think, mentioned nearly all of them. We have the white paper coming out. There's a lot of discussion going on. We have rules on short selling. We have discussions about CCPs, about the governance of CCP, about the structure of CCP, which is, I think, good overall. Plus, we have an ongoing discussion, the challenge to adjust our money market benchmark rates. It's always difficult to have a benchmark rate if there is no market. So it's always a little bit of guessing. Officials, regulators are not aware of this. So this is something in behind where if they have nothing to do, we can have some more issues for them to provide, because this is really challenging, yeah? Especially the money market benchmark rates, LIBOR and Euribor, if there's nothing traded anymore. Okay, so far from my side, short wrap-up, and I hope we have a lot of discussion afterwards.
Thank you, Edward. You mentioned something which we picked up in June when we had the security lending conference in Berlin, where the security lending people thought this new regulation was not going to be applicable to them. And I said, guys, wake up, right? Because, as Edward said, insurance companies are also, of course, included in these financial markets, and they have to go to central counterparties and so on. And so when an insurance company now lends bonds to a bank against less good collateral, this whole thing changes, and so it changes the whole dynamic of the market. So we can maybe discuss this later. The third person to speak today is Jean Robert from Clearstream, and will be followed by Philippe. And between them, they will look at, okay, CCPs, what is actually going on there, what are the developments, and also Jean-Robert particularly will look at the FSA in the UK, of course, is very much, how should I say, the biggest regulator of the financial markets in Europe, because London is so big. What are they looking at for new regulation? And then Philippe will take over straight away with saying, okay, what does this mean for the Russian market on the repo basis, as a G20, of course, country, and the cross-border repo through and CCP. So Jean-Robert and then Philippe.
Thank you, Gottfried. Good morning to all. And so what I will try to outline in a few minutes is what I would call the regulatory challenge for the collateral management and the repo market. So as it has been nicely introduced by Stefan and mentioned by Edward, obviously the new regulations coming progressively and being implemented progressively. I say progressively because it is taking some time, and it will still take some time across the world to be fully implemented. But the major objective, some of the major objectives of the G20 process was and is to give banks stricter guidelines and rules about liquidity management. And this is exactly on that. It's not the only objective, but it's one of them. And obviously, this is in this objective that I would say our market, the repo market, is probably most impacted in its cash investment process, but also in its collateral management process. So in these objectives, there is probably a collective agreement across the different countries and the different regulators on the main facts, which are forcing or asking banks to maintain liquidity buffers or liquidity cushions, as they would call it sometimes, to be able to face any stress test or stress events and sustain viability of the bank for a certain period called the survival period, which is a bit worrying when you have banks or bankers starting to use those kind of vocabulary. But survival period is an official term. So these are the main agreements, the main collective agreement for all regulators, and I would say out of the G20 process, as well as kind of self-governance and monitoring by the institution itself. But the problem, as outlined already, is the different type of implementation of those objectives. And there are a few differences which we can outline already. Like, for example, for those liquidity buffers which are requested to banks, the definition of eligible collateral for those liquidity buffers. So from one country to another, what is considered eligible for those liquidity cushion is different to another. So we're not going to enter into detail, but that's something we have to take into account, because we are, most of us, including you, impacted by those regulations, even if they don't take place in your country, because you have a number of counterparties across borders, and therefore you have to deal with the requirements of your counterparties, even if they don't directly apply to you. Indirectly, you are impacted.
Sure. May I just add some words on the liquidity buffer? Just very nice. We had a meeting with central bank, a big European central bank, and we discussed this liquidity buffer. And we came to the question: what qualifies as liquidity buffer? Which securities? Because they always talk about liquid and very safe. And we said, so it's only German bonds. And he was, no, we can't do this. And I said, well, what else is liquid? Can you tell me? Yeah, well, we have to think about it. And then I raised the question and said, so you are going to tell, or the regulating Greece is going to tell the Greece banks, you are not allowed to hold Greek government bonds. Is this the outcome? And they said, no, we have to differentiate from one country to another country. And I said, okay, then go ahead.
It's a good example of what just explained. So the other differences in the implementation in different countries are the time horizons, which are requested for those liquidity measures, and the reporting periods, as well as the style of recommendations. So in some countries you have strict rules being implemented, and I'll talk in a minute of the UK example, and in others you have guidelines, which most probably will be followed by rules and stricter implementation, but at least initially there are guidelines, and that's, for example, the case for the EU and the Eurozone. So if we take the UK as an example, not that is of particular relevance for the market here, neither for the Eurozone, but as we all know, London being what it is, as a financial center in Europe, obviously it has a strong influence on the rest of Europe in terms of dealing and transaction. So the rules, the other also point, the reason to maybe use the FSA regulations as an example is obviously what Stefan said about the G20. The US have implemented a number of rules which are used as a benchmark for other countries to implement. Within Europe, if we only look at Europe-centric view, obviously the UK was the front leader in terms of implementation for European regulation, and therefore those rules, they are not guidelines in this case, they're rules, are applying to UK-based banks, but also impacting other counterparties indirectly. So very briefly, the main features of, for example, the liquidity buffer as defined by the UK regulation is the definition of prime and non-prime assets. So what is prime, what is non-prime? Exactly that debate you had with your central bank. So here in the UK they fixed, I will not go through the detail, but obviously they looked at government debt and highly liquid collateral, which are mainly multilateral bank debt and these kind of things. So it's very high quality with a minimum rating of AA-, I think, and that's the prime assets. Anything which is not prime is therefore fall into the non-prime category and has different rules in terms of financing. And this is where the concrete practical impact on a repo and collateral management market starts. So in this case, for non-prime assets, so anything which is top of the range, German bonds and a few others, there the financing requirements for the banks are to be extended. So the banks have to ensure that they can finance those assets for a period of more than 2 weeks at all time. Meaning that when you do a trade for 2 weeks, the first day you have a 2 weeks financing period. The next day you are not within those limits anymore. So you have to finance your collateral and securities portfolio for a longer term than 2 weeks to ensure that most of your non-prime assets are financed for a horizon of more than 2 weeks. And this is where, technically and practically, it immediately impacts everybody. Anybody dealing with one of those banks, subject to those rules, will see that the demand from those institutions will change completely, because they will move from a short-term financing model, which we had I would say, subprime crisis or pre-Lehman default, to a longer-term financing transaction. Exactly what Edward said in his concluding remark. So the term financing aspect is going to be changing dramatically the way the transactions are done in terms of repo financing purposes, and also in collateral management in general. Because obviously, whatever is applied for repo transaction, being mainly OTC repo in this case, will immediately impact any collateral management practice in other segments as well. So that's, if we look at potentially the impact of those regulation, that's what we see. If we look and compare those FSA rules with the guidelines which are recommended for European or Eurozone institutions so far, so as I say, the objectives are the same, the definition are slightly different. So the liquidity buffer, for example, in the EU or in the Eurozone would include probably a wider range of assets and include central bank eligible collateral, which, as you probably know, in the Eurozone terms, so the European Central Bank has a much wider basket of eligible securities, and also highly liquid collateral. So that's, which is a broad and a bit vague definition, which is why every bank is querying his regulator or central banks to define that. But at least the objective is the same. But the definition is already different. Central bank eligible assets is not the same thing in the ECB, European Central Bank, or in the Bank of England, and I'm sure certainly not for the Central Bank of Russia either. So obviously there, we talk about the same objective, but the means to achieve it are already slightly different. So therefore the value of the assets on each individual market are slightly different. Also the time horizon can be a bit different in the Eurozone. So what does that mean practically for transactions? So obviously there is an increasing need and demand for rolling term transaction, meaning that trades are done for a period of time, 1 month, 3 months, and being renewed on a rolling basis as much as possible, with at least, for example, in the UK framework, with a 2 weeks notice. So 2 weeks before the maturity of the trade, your counterparty will want to renew that transaction and roll it over. If you don't accept to do it, then they have to plan that trade with someone else, because they need to prove to the regulator that those non-prime assets, don't forget this distinction between prime and non-prime, will have to be financed for at least 2 weeks at all time. There are also other facilities and type of trades which are appearing now, which are what we call drawdown trades, so where banks agree in advance with other counterparty that they have the right, they have a committed facility when they can withdraw some collateral of high quality of assets from the collateral pool of the lender. So we fall back on the securities lending market, where in securities lending we see collateral swaps coming, either being effective or committed facility which allow a bank to withdraw high quality collateral against non-prime assets on call or without notice or with very short notice, so that banks can prove that they can have access to that high collateral quality. Another aspect, but that has been mentioned by Edward also, is the new type of counterparts. So banks, what you have to realize as well, in the interbank market, obviously, there are a distinction here, because some banks have large securities inventory that they need to finance, and therefore they have to respect those kind of criteria. And let's take the example of a UK-based bank, and then we have a European-based bank, Edward, for example, which has more or less the opposite interest. So interbank, it becomes very difficult, and that's why Edward said that now some investment banks or dealers which try to finance their inventory will be looking directly to do that with the buy-side type of customers, so asset managers, non-banks, which might be interested to do that and which are by nature longer-term investors. So it's part of their investment profile anyway, but usually not in repo transactional financing trades. And that's the kind of request we start seeing now in our collateral management services, which to play a role of collateral agent between non-banks and banks increasingly. So the impact also, and the request we see as a collateral agent and as a piece of infrastructure or market infrastructure is obviously to be able to provide collateral management services for different types of transactions, but they have to be interconnected. And I think that was raised already yesterday by Philippe in his presentation. So being the repo type of transaction, securities lending collateralization, central bank collateralization, being all integrated so that allowing flexibility between those type of transactions for the same institution. Also to support different type of transaction between on a legal point of view, between the transfer of title and transfer of ownership, repo type, or pledge type of structure. Obviously, we are requested increasingly to tailor our service so that we can help customers to distinguish prime from non-prime assets, which is not always easy, as we explained, because of the vague and broad definition. Important aspect are also the possibility for the banks to finance on a long-term basis, but to allow for substitution. I mean, yesterday in the legal debate or panel, there was a debate on for the right of substitution in the Russian market for repo transaction. Here, obviously, the right of substitution, when you commit for a long term, is very important because banks want to finance their inventory as a bulk, as a large portfolio, but they want to have the flexibility to sell any of those securities at all time. So the right of substitution and automatic substitution and reuse of collateral is very important. And so in terms of conclusion for that aspect, and maybe we'll cover the CCP aspect later, is what the way we see the market evolving in terms of repo and collateral management is really, I would say, two-tier. So we say the prime assets will be financed in highly standardized and GC type of standardized baskets on a very short-term basis. But in that case, increasingly through CCPs. Because the trend, if the product is being standardized, is obviously, and short-term in that case, it will be to try to automate the process, use STP processes as well from trading to settlement. And therefore, the prime type of assets will increasingly filter into the CCPs, also because these are the only assets which are eligible to CCP. CCPs, as Gottfried says, would be not very keen, none of them are so keen so far to enter into non-prime assets category for central clearing. The second part, so the non-prime assets, which are still there and will be maintained and will require longer-term financing, will increasingly move towards longer-term financing transaction supported by the collateral management services such as tri-party, but those transactions will be maintained as OTC transactions because most of the case they are bilaterally agreed, structured transactions, sometimes very long-term, and we see that increasingly, as Edward mentioned, as tri-party agent, and that we can see developing. So the nature of, for example, tri-party repo has completely changed from what it was before 2007. We had a very short-term market, like in the US, and we had the same in Europe. And now we are supporting tri-party transactions for a much longer term.
Difficult to assess, and as I'm not one of those regulators that can decide what the rule will be 10 years from now, I would prefer to refrain myself to going into any sort of direction which are very likely to be incorrect. What is clear, though, is that Russian banks are more and more working on the international sphere, and therefore you will be bound by the rules that will be applicable to your counterparties being in Germany, in Italy, in France, or in the UK, because those banks will have to apply the new rule, and therefore their way of trading will be affected, and therefore your way of trading will be affected indirectly as well. We are in a world of changes. very fast. And we are in a world where trust is gone. There is no trust between banks. And this is maybe one of the reasons why everybody is talking about CCPs, central counterparties. Because basically, from a risk point of view, you move your counterparty risk from bank A or bank B to a CCP. Regulators feel more comfortable because they believe that a CCP intervention is more regulated and there is more transparency because there is a trading book and they feel they have a better control of the market. Your risk management is probably more comfortable because a CCP going bust, if your counterparty was to default, and by the way, you didn't know your counterparty at the time of trading because usually there is anonymity, is much more remote. So there is a feeling that because you're working with CCP, your counterparty risk is reduced. And then we come to collateral. We've discussed prime assets, non-prime assets, liquid assets, not liquid assets. No one knows exactly what these are, and this may change very quickly. Edward mentioned AA plus as one of the rules, or Jean-Robert, sorry. Well, it's very well be that tomorrow one of those AA plus country becomes AA. And then what do you do? The other thing is pricing. How do we make sure that the pricing that we use to value that collateral is indeed a good enough indication of the price we will be able to get if we are forced to sell those assets? And we've seen that if a bankruptcy like Lehman occurs, then the market dries up very quickly, and that price, even including the haircut that you've taken, might not be enough. So those are different elements that are favoring CCP, because the CCP is supposed to value that collateral and to have a mechanism, and you would not be forced to sell the collateral. The CCP would be in the situation to do it. So yes, indeed, CCP are very likely to grow in terms of business for the assets that are eligible to them. And one of the very important elements of the CCP, as mentioned yesterday by Bert, is that those assets can be easily refinanced with the central bank, because by definition what the CCP takes is usually central bank eligible. So the collateral that you've received is eventually reusable in an easy way, and on top of that, the collateral that you take is standardized through baskets, so it makes it much easier for everyone. So CCP is clearly the trend. Now there is another dimension that we need to add, certainly we've seen that in the last few years, is the cross-border. You have assets not only in Russia, you probably hold assets, you hold German bonds, you hold French OATs, you hold corporate debt. In the past, there was not really a need to finance those assets. Maybe there was a need, but not to the extreme that we know today. So now how do you do that? And as I think Edward or Gottfried mentioned, in terms of crisis, everyone goes back home. So you want to finance those assets with your own central bank. How do you get your Italian govies financed with Central Bank of Russia? Ideally, it should work. In reality, yes, it's feasible, but it's very complex to achieve. So what we need to do as market infrastructure is to find a way to help you mobilize the assets that you hold outside of your home country, but that you could use with your home central bank without the need for realigning the position. Because that realignment is a nightmare for the front office, and even a bigger nightmare for the back office. And until we address that, there will be a barrier. So that's another element which, in my view, will be very, very important. As Jean-Robert, we also see a move towards the buy side, entering the repo market. I think there is another dimension that is forcing them to do more repo, is again the lack of trust. Do they trust the banks? Do they want to be unsecured on the banks they were doing the business with before? So I think that what the interbank market has known 2 years ago, and basically moving to a very large extent from the unsecured to the secured market, where we see the corporates and the institutional investors having the same approach and the same thinking process today. So this, I believe, is something that will probably go forward as well. One point maybe I would like to come back on what Alex Stein mentioned earlier on about the US and the UK market. Indeed, I will talk about the UK that I know better. There is a repo market that exists in the UK, but it's an overnight repo. So at the end of the day, you finance your position, you get the cash. First thing that we do as a CSD in the beginning of the process is to unwind all those repo transactions. And indeed, it creates a huge need for liquidity because everyone is deadly short cash at the end of the day, because all your financing that happened last night has been unwound. About 40% of those repos are term repos. Okay, so you create, for 40% of the total volume, an unneeded liquidity need. And that is one of the reasons why we are working to introduce a term repo in the UK. Should be launched middle of next year for two reasons. The first one is the Bank of England is obviously not very happy to see huge funding needs for their banks where it's in fact not really needed. That's the first driver. And the second driver, as Jean-Robert mentioned, banks need to be able to prove that they fund their position at least for 2 weeks. So how do you prove that if you have an overnight repo that you roll over permanently? And this is what we know today. I'm sure that we will have something else tomorrow, and we will need to adjust. We will need to be agile in managing our infrastructure to try to meet the requests that are coming on a very, very regular basis to do things differently.
Thank you, Philip. So you had a good overview of the issues. One of the issues we didn't discuss, and we won't have time, is the CCP, Central Counterparty Clearing, in detail. What I can tell you from discussions I have in Brussels is that there's a new group, expert group, Market Infrastructure it's called, and I had the honor and the pleasure to be part of that. The funny thing was that the last meeting we had 2 weeks ago, we actually discussed how to unwind a Central Counterparty Clearing, which is very, very strange because the politicians tell us everything has to go to there, and now we already start discussing with officials how to get out of it. So something is not right. And the issue there is that we're not very sure if they can actually price everything very well, if they have the right to unwind everything in all the countries where they actually have bonds or positions, because CCPs don't only sit in a domestic market. And so that is something you have to keep an eye on it. I know you're introducing CCPs here in Russia as well in different products. I think it's a good push forward, but it's not going to be the solution for all your issues you have. One of the issues we all have, and Lisa talked yesterday about the GMRA, is that when I talk to international banks, not based in Russia here, because here they understand it very well, is what about the legal landscape in Russia, and particularly for your domestic markets, how are you going to solve, for instance, the close-out netting? So I thought it was very good to have Michael here from Freshfield to talk about this very briefly, because we're running out of time, but we have 10 minutes. Okay?
Доброе утро, дамы и господа. Я продолжу тему регулирования, которая красной строкой проходит через